Welcome to The Explainer. I'm absolutely thrilled to have you here today, because we're tackling a subject that honestly sounds straight out of science fiction, but it's happening right now, at this very millisecond. Today, we're demystifying the incredibly complex computational methods that are completely reshaping Wall Street and global finance. We're going to look at some cutting-edge research on how artificial intelligence is moving way beyond basic automation and fundamentally transforming market analysis and risk management.
So, it's the ultimate question, isn't it? Can an artificial intelligence truly outsmart the collective, chaotic, and highly emotional human system that we call the stock market? Well, for decades, quantitative analysts have tried to build algorithms to beat the market. But what we're seeing today, it's a total paradigm shift. We're dealing with massive, non-stationary datasets, high-frequency trading, and insanely complex global networks. To really grasp the sheer scale of AI's financial impact right now, we just have to look at the numbers.
28.4%. That is a massive number. Research actually shows that modern reinforcement learning frameworks are currently achieving 28.4% higher risk-adjusted returns compared to traditional static trading strategies. I mean, these aren't just algorithms following simple buy low, sell high rules anymore. We're talking about adaptive agents that continuously learn and optimize their policies against real-time market volatility. They're literally learning the game of finance as it's being played.
Here's our roadmap for this explainer. First, the AI finance revolution. Second, predicting the unpredictable. Third, reading the market's mind. Fourth, the financial immune system. And finally, unlocking the black box. Okay, let's jump right into part one, the AI finance revolution. Specifically, the three pillars of computational finance. To really wrap our heads around how AI is applied in the real world, the academic literature breaks down the modern financial AI ecosystem into three foundational pillars. This brilliantly illustrates the shift happening right now. First up, we have predictive accuracy, using AI to forecast market trends and generate higher returns. Second, risk mitigation. This is all about detecting anomalies and fraud with just unbelievable precision. And third, decision automation, executing massive complex trades, like 200 asset portfolio allocations, exponentially faster than humanly possible. Pretty much everything we talk about today is going to map right back to these three core objectives. Moving on to Section 2, Predicting the Unpredictable. We're focusing here on deep learning architectures.
You know, financial markets are notoriously chaotic and noisy. For years, the gold standard tool for forecasting all this noise was the ARIMA model, basically an autoregressive, linear way of looking at time series data. But here's the catch. Traditional human-designed economic models often assume a level of linearity that simply doesn't exist in the real world. But when we compare that to modern AI, specifically bidirectional LSTMs, the difference is absolutely staggering. By utilizing skip connections, these AI models actually reduce prediction errors on the S&P 500 by a massive 23.4% compared to those older ARIMA models. And they do this because they're specifically designed to capture nonlinear patterns and long-range dependencies in the data that older models just completely miss.
Now, what's really interesting here is when we look at hybrid models, like the CNN LSTM. By fusing spatial and temporal data, meaning it processes the structure of the data and its behavior over time, this hybrid model achieves a 31.2% higher Sharpe ratio on the NASDAQ 100. And remember, the Sharpe ratio measures risk-adjusted return. So this AI isn't just making more money, it's doing it while taking on less relative risk. We're also seeing dual attention networks driving a 14.8% forecast improvement in forex markets, and capsule networks reducing false trading signals in commodities by over 37%. A real game changer.
Let's pivot to Section 3, Reading the Market's Mind. We're diving into the power of sentiment analysis. So we're shifting gears from hard numbers to human emotion. Markets are driven by fear, greed, and the constant, relentless flow of global news. And we now have AI systems that act like ultra-fast readers. This is the whole domain of sentiment analysis. In finance, this utilizes advanced natural language processing, or NLP, to bridge what researchers call the semantic gap. Think of the semantic gap as this massive divide between raw, cold, quantitative numbers and the qualitative, chaotic human emotion you find in financial news, Twitter feeds, and corporate reports. Sentiment analysis swoops in and extracts actionable insights from all of this unstructured text, almost instantly. And I gotta tell you, the accuracy is just mind-blowing. Take a look at this. When a hybrid model combining BERT, which is a highly advanced language model, with an LSTM network was unleashed on complex corporate earnings calls, it didn't just guess the tone.
No, it achieved an incredible 91.2% precision in classifying sentiment. Other models, like Word2Vec, combined with ByListM, are analyzing social media sentiment with over 87.4% accuracy. Meanwhile, ensemble sliding window models are dropping false positive rates from mixed news sources by 37%. These models are literally parsing the nuance of corporate speak to predict stock movements. Crazy, right?
All right, Section 4, the financial immune system. Let's look at AI in risk management and fraud detection.
Making money is only half the battle, right? Protecting it is absolutely critical. While some AIs are out there hunting for profit, an entire secondary class acts as this kind of immune system, constantly scanning global networks to hunt for anomalies, manipulation, and fraud. When comparing different methods, graph neural nets actually reach an incredible 96% accuracy in mapping and catching fraud, slightly edging out autoencoder clustering. They do this by treating financial transactions not just as a static list of numbers, but as a complex, interconnected web or graph. They map financial indicators onto these structures to reveal hidden money laundering or fraud networks that traditional rule-based systems are just completely blind to.
And it goes way beyond standard transactional fraud. The research shows that by using advanced techniques like kernel principal component analysis, these systems are catching high-speed market manipulation. We're talking specifically about a practice known as spoofing in the limit order books, and they're catching it with 93.1% precision. The AI identifies nonlinear anomalies in the order book data almost instantly, basically protecting the integrity of the market from bad actors.
Finally, let's move to Section 5, Unlocking the Black Box. This is all about the ethics, opacity, and future of financial AI.
Okay, so we've clearly established that these models are incredibly powerful, but their sheer complexity creates massive regulatory headaches. Think about it. If an AI makes a financial decision that affects millions of dollars or real human lives, we have to know exactly why it made that decision. So the crucial point here is this deep contradiction. We have models with exceptionally high predictive accuracy, but incredibly low explainability. Deep neural networks are essentially black boxes, and regulators are definitely noticing. Current studies show that only 42% of these black box trading models actually pass the European Union's strict MiFID II transparency requirements. You can't just tell an auditor, well, the computer said so. You need a documented step-by-step decision trail.
Fortunately, the industry is already developing a really elegant solution called Explainable AI, or XAI. By utilizing frameworks based on shop values, which is actually a concept borrowed from cooperative game theory, researchers can quantify the exact importance of every single feature the AI looked at. These XAI frameworks can restore interpretability to 89.3% of the model's decision trail. That leaves only a tiny 10.7% fraction of unexplained variance, all while maintaining that high regulatory compliance and top-tier accuracy.
Let's look at how this builds into the future, because this is literally just the beginning. The next-generation architecture is already being tested as we speak. Quantum-inspired neural networks are showing a 27-time speed-up in solving massive 200-plus asset portfolio optimization problems. Neuromorphic computing, which actually mimics biological neural processes, is dropping the massive energy consumption of high-frequency trading by an astounding 94%. And neurosymbolic systems, which combine neural nets with logical knowledge graphs, are reducing algorithmic bias by 37.5%. That promises a much fairer future for financial AI.
But as we look at this incredible leap in capability, we absolutely must confront the ultimate socio-technical question. If a fully autonomous AI agent operating at speeds and complexities way beyond human comprehension makes a disastrous trade that crashes a market, who is held accountable? Is it the programmer, the financial institution, or the algorithm itself? The intersection of technology, regulation, and human accountability is the next great frontier in finance. Definitely something to think about. Thank you so much for joining me on this explainer.
Thank you.